What signal for the economy, for inflation, and Fed policy do you take from this report?
Well, I thought it was a really good report. Obviously, 313,000 jobs created on the payroll basis. We've had very strong payroll growth for many, many months now. State of the labor market is vibrant. Clearly, the unemployment rate at 4.1% continues to be good. I would say that the increase in the labor force participation rate is a really good sign. More people are coming in to the workforce. The unemployment rate is sort of, continued to stay at that 4.1% rate. That ends up being a good sign on the heels of the 300,000 payroll employment. You mentioned wage growth was a little on the weak side, and so this is one of those interesting developments that even though the job market is very strong, we still haven't seen really strong wage growth. I'm looking forward to stronger wage growth in the future. I'm looking forward to all of these things leading to a stronger economy and stronger inflation, more in line with our 2% inflation objective. I think we're on a pretty good path.
So where do you tilt more towards, Charlie? Because you've talked about both aspects. You're looking at 2.5% to 2.75% GDP this year. I think you've mentioned recently could even be 3%.
Right.
But you keep saying, hey, inflation is still below target. It's core PCE 1.5% average for 8 years.
Right.
With a jobs report like this, does Charlie Evans say, well, I'm getting more on board with a March rate hike than I was when I dissented on the December hike, or even in February when you expressed the same kind of caution?
Well, I think the economy is doing very well. I think it's likely that inflation is going to pick up, and so that's a good thing. On a tactical basis, I can see the merits of arguments where, we continue our gradual increase in rates. What sort of tips it for me, at least as I'm thinking about this, is at a more strategic level. I think that the long period of inflation below our inflation objective has been very difficult. It's been associated with difficult times, and the time that we spent at the so-called zero lower bound was just really painful. So the funds rate was very close to zero for, so many years, and that was a sign that the economy wasn't performing as well as we wanted it to. In the future, at some point, years from now, the economy is going to have a difficult spell. And if we go into a recession, normally the Fed has to lower the funds rate by 500 basis points. And so I think it's very important that we have as much monetary capacity to respond to that difficult time as possible. So I think it's very important to ratify 2% as a symmetric inflation objective, and that markets have inflation expectations truly consistent with our objective. I'm nervous that they're too low, and I believe that just by being a little more cautious, waiting to see if the March inflation data come out in a better way relative to a year ago, that could be helpful for us.